Hi, this is Charles Weeks with another Barrister Brief. Today we're going to cover a few different topics. First, we're going to talk some geopolitics. Then we're going to cover private credit and private equity, alternative investments generally. And then we're going to finish off talking about portfolio construction and kind of what those first two topics have to do with what's going on with markets today. So to start off, let's talk about the war in Iran and kind of what impact that's having on the economy, on global markets, and why we might even, why are we doing it? Why are we there? So obviously, the Iranian regime has done horrific things over the years. We've known about it for years, but there's never been this type of attack, to try to change the regime. So why are we doing it now? And again, this is just my opinion. Um, take it for what it is, but uh, and then kind of what impact our actions have, just generally speaking. So uh, China gets a lot of their oil from Iran and from Venezuela. So we very quickly took out the regime in Venezuela, and we're trying to install, or we didn't install, but we're working now with someone there that is supposed to be friendlier to our country, and we're trying to do the same thing with Iran, but obviously we couldn't have the same type of mission there where we just sent in some special forces, took out the leader quickly, and without kind of a bigger, broader conflict. So with Iran, we put together this bombing campaign and look to inflict so much pain that the citizens would rise up essentially and work to change the regime themselves. That obviously is not happening yet, and from you listen to what a lot of experts say, it's very difficult in Iran for that to occur because there's not one specific person there that can kind of lead at this point any type of revolt to overthrow the regime. So, what was Iran's reaction to the bombing campaign from the United States and from Israel? It was not just to attack Israel, because a lot of the missiles and drones they send that far away get intercepted, but it was just to attack countries all around them. So, Dubai, UAE, um, Cyprus, they shot a drone at, and it was to try to inflict as much pain as they could regionally, so that they would then put pressure on the United States and Israel to stop what they were doing. They also recently shut down the Strait of Hormuz, and even as of last night, now Iran fired either missiles or drones and took out a couple cargo ships, and have warned nobody to go through the strait. So I think the number is about 20% of the world's oil comes from that area, and it has to go through that strait. So there's producers right now that are just essentially shutting down production over there because there's no place to store the oil, right? So you're not gonna pump it, refine it, and everything else, and have it just you have to have somewhere to store it. So oil prices have skyrocketed. That is going to have an impact on gasoline prices soon. But again, why are we even doing this? I think it has to do more with China than it has to do with anything else. So again, China was getting oil from these places. China kind of saw the writing on the wall, and they've been stockpiling oil. And I think this is just a slow buildup to, unfortunately, what will be an eventual conflict with China over Taiwan and other things. So we've been in this trade war with China now for a good amount of time. China, in an effort to kind of fight us over the trade war, was going to withhold rare earth materials. And I think this is kind of our answer to them withholding those rare earth materials. We're like, okay, we're going to work to withhold your oil. And that's going to mean, conflict with Venezuela, conflict with Iran, and trying to shut off that oil going to China. Interesting enough, some of the oil tankers that apparently have moved through the strait were Iranian tankers heading to China with oil. So, whether we're doing a good job shutting that down now at this point, I don't know that we can actually bomb those tankers, or that we would bomb those tankers, though, of that oil heading to China, because that might then, that might start a hot war with China, right? So I think this is all a slow buildup, though, to what will eventually be a conflict with China. So I think that's why we're there. I'm not sure, obviously, if it's a war. So we don't know what the outcomes are going to be, what the likely outcomes are. I'm trying to research and listen to as many experts as I can to try to get an idea of, how we should position portfolios and do things like that, um, given what's going on. But we'll talk about portfolio construction in a minute. But I do think when I read about Iran and why we're there and what we did with Venezuela and the focus on kind of the Western Hemisphere and things like that, it seems like, and even with what we did with the cartels in Mexico, China was sending a lot of fentanyl to the cartels in Mexico, who were then pushing that up into the United States. China was making a lot of money off those fentanyl sales. So the idea of, hey, let's fight the cartel, shut down those fentanyl sales. We're going to shut off oil going to China from Iran and Venezuela now. It's all kind of this slow buildup to what seems like it's probably going to be an eventual conflict with China. But so that's kind of Iran and the Strait and what's going on now. Private credit is the next kind of big thing that you're hearing a lot about. It's in the news a lot. It's in the paper a lot. It's on CNBC a lot. So what is private credit? I actually, in my writings last month that I sent out, I touched on private credit and private equity. And my point of that article was buyer beware. Be very careful, because there is push to try to get these alternative private investments put into 401ks. And I do not believe that is a good place for those private investments. Private investments historically were really only for accredited investors. So people that had a significant amount of assets that they could tie up for long periods of time. They did not need liquidity, meaning you're not going to need access to those funds. And the idea being, I'm willing to tie it up into private investments for a long period of time, and I'm going to earn a little bit more than I would in public markets. Sometimes if the investments were good, you earned a lot more than you could in public investments. But part of that was they were higher risk and they were not liquid. They were illiquid. So there was a illiquidity premium associated with those. You earn, part of the reason you earned a higher return is because you're willing to tie up your money for 10 years or 20 years. Kind of long story short, after 2008, there were a lot more banking regulations put in place. And banks couldn't lend money like they previously could to a lot of middle market companies. So not your Googles of the world and not your small businesses, but your middle market companies that were, looking for loans to grow the business. There was a hole in the market for that. So that's where private credit was really born. And it was also kind of tied into private equity, where at the same time there was this hole in borrowing, this need for borrowing. There was also this massive growth in private equity, partly fueled by really low interest rates. So I make the joke of, if you need an HVAC company, or if you need to call a plumber, and you look for your local directory, and you go to call a plumber and you try to call 3 or 4 different plumbers, you kind of get the same call service for all of them. Well, part of that is you had private equity companies going in and rolling up all these businesses, whether they were registered investment advisors like what Barrister is, whether they were HVAC companies or plumbers, you name it. Private equity has tried to roll up roofing companies. Private equity. They would raise funds from investors and they would buy up all these businesses, and they would try to streamline the operations, put them on all computerized services, maybe lay off some people if they had to, and make higher profits. Well, the way they were able to go on those buying sprees was they had to borrow money, right? They had to borrow money from somewhere, and a lot of that was borrowed from private credit funds. So, and a lot of that was fueled with just really, really, really low interest rates. So, if you showed me any cash flows 5 years ago from any business, if I could borrow money at 3, 4, or 5%, almost any cash flow looked really profitable at a present valuation, right? So whenever you have really low interest rates, it makes future cash flows look really valuable. As interest rates go up, those cash flows look less and less valuable, especially if you have to, and now you run into this wall where you might have to refinance at higher rates. So what you used to be able to borrow at 5%, you now have to borrow at 10%. Well, that can create an issue. And there's a lot of these companies that borrow through private credit funds that no longer have the ability to make payments on their loans, or what they'll do is they'll have what's called a PIK payment, a payment in kind. And instead of actually making a cash payment, the interest just gets capitalized and added to the amount that's borrowed. So there's a whole lot of issues right now in those markets. There's issues in the private equity markets in that private equity no longer has new money flowing in. They don't have anybody to sell to, so they can't really raise capital to go out and do other transactions. And then on the private credit side, you have higher interest rates, and then you have borrowers that can't make payments to some of these private credit funds. So investors in these private credit funds are all of a sudden saying, I'm nervous, I want my money back. A lot of these private credit funds only allow maybe 5% of the total value of the portfolio to be redeemed in any quarter. And then once that 5% cap gets hit, you can't get access to your principal anymore. They've had so many redemptions that now a lot of these private credit funds are just putting gates up and they're saying, we're not going to redeem it all. You just have to leave your money in the fund and we'll eventually give you your money back. So to me, this is an important lesson because it seems like we generally are very forgetful about what occurs in our lives. It's easy to write things off. And maybe part of that is human, right? Like we need to ignore trauma and pretend it didn't happen so that we can move forward in life and do things, live as if it didn't happen. But to me, it's especially as an asset manager, it's extremely important for us to remember what's occurred in the past. So we try to avoid making similar mistakes in the future, right? So I always talk to clients about chasing yield. There's no reason for us to chase yield. You invest in bonds to get what the bond market gives you. Part of that is diversification, and part of that is whatever the income is that you're going to get. There's a reason private credit funds were offering yields of 10% because they were really high risk. They were making loans to borrowers that were high risk borrowers. So yeah, 10% sounds amazing. Give me a 10% yield. Oh, but it doesn't sound so amazing when I can't get access to my principal, or maybe I don't get my principal back. So if you buy a treasury and you're getting 4% on the treasury, but 10 years from now you're going to get your principal back, well, that's great. I'm happy with that. I know I'm going to get my interest payments and then I'm going to get my principal back at the end. Whether it be, I remember back years ago, they were master limited partnerships, super, super high yields, and then all of a sudden you lost 50% of your principal because they couldn't make their payments. Whether it's, auction rate preferreds during the 2008 crisis, or collateralized debt obligations. Anytime you start selling yield and pushing yield, you're essentially giving people equity level risk in fixed income, right? That's what it is. And at some point, it's likely that, you're going to have to pay for that. You're going to have to pay for that yield. There's always, that idea of it's too good to be true. It usually is too good to be true, right? So you're hearing a lot about private credit, a lot about private equity right now. In a nutshell, that's kind of what's going on. The private credit market is now massive. There's different numbers you read, anywhere from 1.8 trillion to 3 trillion. The subprime loan market was something like 1.5 trillion. And that had a big impact, obviously, on what occurred in our banking system, because there were so many banks that were tied into that, and pension funds and everything else. Could private credit have that same impact? I'm hesitant to say that it would, because our banks are better capitalized now than they were. But private credit has its tentacles in a bunch of different things, right? It's in pensions, it's in endowments. A lot of life insurance companies have invested money in private credit. So if we do have this revaluation of private credit where it's a $3 trillion market, but it's really only worth $1 trillion, that is going to have an impact on our economy. So again, how that impacts client portfolios, we don't have exposure to private credit. It was not something that I felt comfortable putting clients in, because I felt like it was equity level risk, very below investment grade credits, and the yields sounded great, but there's risk in that. You're taking a lot of risk to get those yields. So kind of how does all this impact portfolio construction and the portfolios at Barrister and what we're seeing and everything else? So with what's going on in Iran, we're seeing a big run up in oil right now. past few weeks alone, just huge increases in year-to-date performance for oil. Thankfully, in our portfolios, we have a pretty significant allocation to commodities, and we've been defensive in our portfolios for a period of time now, for a couple of years. So we were definitely a little early in getting a little bit defensive in our model portfolios, but the markets have been overvalued for a significant amount of time. It's just getting more and more extreme valuations. But there's this old adage that bull markets don't die of old age. Something kills them, right? There's something that happens, and all of a sudden people say, oh wow, we need to reduce the amount of risk that we're taking, and it seems to happen all at once. And these valuations have been out there for a while. So whether it's the Shiller index, whether it's the Buffett indicator, price to sales, all these things have been at very extreme levels, right? Like 98th percentile standard deviation levels of market valuation. But the market didn't sell off, right? We kind of just chugged along. We knew that there was concentration risk and all these things, and there was a lot of people aware of what was going on in private credit. But it just seemed like, again, the reality is, when people are making a lot of money off of things, they don't want that narrative to change. So when private credit was making a lot of money for people, we just want to ignore it until we kind of have to deal with it. The market's going up, so let's just ignore it until we have to deal with it. And then all of a sudden it happens, and we have to deal with it all at once. Again, as an asset manager, what I try to do is I try to avoid ride as much of the good times as we can, but try to avoid as much of the drawdowns as we can, which are eventually going to happen. So willing to give up a few points in good years so that we try to avoid the big drop in bad years. And I try to make the numbers, we use these big numbers because it's easier to kind of visualize. But if you lose 50% of your portfolio value, you have to earn 100% just to get back to even before we start making money again. I don't believe that we're going to have a 50% drawdown, but who knows, we could. But just generally speaking, if we only lose 5% instead of losing 15%, it's going to be a lot easier for us to get back to break even than to start making money again. So the good news is the portfolios were already defensively allocated. So there was a maybe 20% reduction in equity allocation overall. So whether you're aggressive, moderate, conservative, we've already had that reduction in place. And then we also had a healthy allocation to commodities, which have underperformed for a very, very long time. And it just, for a few years now, they've been poised to do well. It was gold, a couple of years ago, and for gold had a good run for a couple of years, and now it's oil that's doing well. But there's been a bunch of different commodities over the past few years that have done well, that have added to the portfolio. So portfolio construction is super important. It's trying to avoid those things that could potentially blow up or could limit your access to your principal. Like, again, private credit sounds great, a 10% yield sounds great, but then all of a sudden if someone comes to you and says, I'm really sorry, but you don't have access to your money anymore. Your money's been gated. Don't worry about it. We're going to let them manage it. The funny thing is, these private credit funds are still charging asset management fees on the money they're literally not letting clients get access to. But that's a whole other story. So it's trying to avoid those assets that can blow up or can limit principal, limit your access to principal, and then staying diversified and then seeing when there's writing on the wall. Like, again, a few years ago, we had an inverted yield curve, which is usually a precursor for a recession, but we didn't get one right away. We hadn't got one for a long time. A lot of that is likely because we had such low interest rates for such a long time that it takes time for all of that to kind of pull through the system before we have economic reality. And it seems like we're starting to deal with some economic reality now. High oil prices will cause high gasoline prices. That's an issue. This whole private credit thing is going to be an issue. And again, before all this stuff even happened, we were at extreme valuations on the S&P 500. So we had to live in like this perfect world for nothing to happen, right? And obviously we're not in a perfect world right now. So my message is that you want to stay diversified right now. You want to not make any rash decisions based on what's going on in markets. Things are very chaotic and things can change very quickly. I don't believe the situation in Iran is, you might hear things day to day like, oh, well, it's going to be a quick campaign, or The regime is almost done. It's going to be, I think, it's going to be, I think it's going to be a longer conflict than that. From what I've read, it seems like from a lot of experts, Iran has been preparing for this. They're firing on neighbors, and again, I think this is all part of a bigger conflict that we're having with China. That's just this slow kind of moving conflict between trade wars and withholding certain commodities from each other and everything else. So I think you want to stay diversified. I don't think you should ever be all in or all out of markets because we never know what's going to happen or what can happen. But I think within your portfolio, you should find exactly what you're invested in and think about what impacts a recession might have on those things. In fixed income, I'm still a big believer in staying in very short duration, very safe investments like treasuries, and taking very little risk in fixed income. Be happy with whatever yield you're getting from the fixed income market. It's a lot better than it was a few years ago when we were in zero interest rates. And then having a nice allocation, to commodities and to real estate can be beneficial as well. So we'll try to stay on top of what's going on and share our opinion with you as much as possible to try to help kind of understand what's going on in markets and geopolitics and everything else. So as always, if you have any questions, please feel free to reach out to us. Take care.